Hello and welcome. You're watching Business Plus. Have you ever wondered why some states get more money from the centre? What is the revenue sharing formula? The thorny issue of revenue sharing between states and the centre has once again cropped up, with a report stating that southern states are continuing to bear the burden of ensuring development of backward states. For the uninitiated, the centre's tax collections are pooled in from the states as a part of it is distributed among states. The Finance Commission's formula is skewed in favour of some states, resulting in wide interstate variation. As population is given a higher weightage, it tilts the balance in favour of some northern states. Now, in a country like India, how can we achieve an equitable distribution with this structure? That, of course, is the big talking point that we're discussing here. With me in the studio is my colleague Brijesh Pandey, who's the political editor here at Newsline. Brijesh, the statements that the southern states are making really augurs well within the entire country, because as we were discussing just a couple of minutes back, it feels like you're giving higher weightage to a child that is underperforming, for that matter.
I think, that is not going to be politically correct for most of the people. But yes, I think, what PTR Tyagarajan has been saying is something which makes sense. I'm not saying that, you have to allocate the situation, allocate the fund to a level where it is like you're completely in the favor of the states which are paying more. But then definitely you have to meet them midway. You cannot penalize a state for being very efficient, for contributing more to the economy and being self-sufficient. PTR had a very valid point that this means that whatever is going down, whatever is being allocated to those states which are not performing up to the mark, then there has to be a system which has to be put in place to ensure that at least you are tracking the money where it is going, and if it is not performing up to the level, then you should be in a position to counter them, ask them, and hold those states responsible for not being up to the mark.
Okay, I think the classic argument here in this case is that these states that get more money are usually those states that have higher population. How far do you justify this formula where states with higher population are getting more funding as opposed to states that are really doing well?
Well, there's a time when when you actually have to look after the states which have not performed that well, or like the the saying goes, the Bimaru states and all, especially which is related to North India. But the fact is that yes, they have to be looked after. But the percentage which decides, the population is the only percentage which is the major determining factor. Then I do agree that it needs a bit of a relook, though it will further fuel this north-south divide, and it will become politically a contentious issue as far as the southern states and the northern states are concerned. But I think they do have a merit. It does need a relook, and states which are performing, you cannot penalize a performer and just to put everything back to the underperformer. Theoretically, yes, it makes sense, but even if the underperformer is there, then you have to balance, the proportion has to be balanced before it gets out of hand.
Okay. Okay, my colleague Rakesh Kar is also joining us in the newsroom. Rakesh, a fair point there. You cannot really punish the performer while keep supporting the underperformer. I want to understand this from a finance point of view, from an economics point of view. How exactly does Finance Commission meet, and why hasn't there been a change in the formula over these many years?
See, it's a ticklish issue. They have to balance, the overall kitty has to grow first of all. Let's all contribute to growing the overall kitty. What happens is that if you don't grow the kitty, this division between less rich states and poorer states will keep continuing, and there will be a battle on that. This demand has taken place again in the recent past because of this larger federal India story. What's happening is that if there was a BJP ruled state in the south and the centre is being ruled by the south, this particular wouldn't have happened.
Absolutely.
So it's more political, less economics, unfortunately. We have to look at this story with general elections happening in 2024. The demand for a south to get better paid than what is happening right now is going to increase. What is the role the Finance Commission can do? It has to look at the overall kitty, see how it grows, and then how does it get distributed fairly. There is merit, like Brijesh was saying, in southern states asking for a little more money accruing to them. But who will feed poorer states? When we got independence 75 years ago, there was one nation and everybody looked at growing the economic kitty. So that basic objective has to be sustained. I think we must not fall prey to this demand in terms of making a political point of it, but engagement has to be continual. Finance Commission, Finance Ministry, respective finance ministers must get together and see how they can try and bridge this demand supply gap between rich and poor states.
Okay.
And there's another interesting perspective to this. If you look historically in the last decade or so, a state like UP is asking and aspiring to be a 1 trillion economy. So if that's happening, in that context, every state has an aspiration to grow. It's not that we have a poor child not imagining to get rich. So the rich are getting richer, but the poorer states are also wanting to do better. Chhattisgarh, for instance, it also has made announcements. It's working hard to try and improve itself so that it can stand on its own 2 feet.
Okay. You know what? One of the British, before I get you in, one of the contention is that states, despite getting substantial share of the revenues, like UP for that matter, and we are talking about $1 trillion economy, but they haven't developed as substantially as, let's say, a state of Tamil Nadu or Andhra. I mean, the states continue to push for the fact that where exactly is the money going if there is no development on the ground?
Well, I think fiscal prudence and accountability for money which is being given to the state is one subject which I think everybody would really want to know, because the governments or the political parties make all kind of announcements just to make sure that they get votes or they get to form a government in a particular state or win elections. The OPS scheme is another big bone of contention as far as whether good politics makes for very bad economics. And I think Rakesh had a very fair point there. It's run up to 2024 election. If you remember, 3-4 months back, PTR Thiagarajan was very vociferous and defended himself in a national TV channel where he took the BJP guy for task. He's saying that we are the one who are performing better, and you are the one who is sitting there and lecturing us. So this confrontation, is something which is going to increase further as we go towards 2024 general election. Okay,
what can we expect from Finance Commission, Rakesh?
Finance Commission meets continually. We must not expect and put too much hope on Finance Commission. We have to address, it's an academic institution in that sense. There has to be political intervention. I think the Government of India, the center, has to engage with various states, both the developed and the developing states, and say that you would have tremendous pressure from your domestic constituency, that's the voter, and the citizen of that state to ask for more. But you have to do a fine balance, and the engagement process at the political level, at the administrative level, will yield better results. And also the key argument has to be that, for instance, Tamil Nadu, Brijesh mentioned. Why is it that companies of large size or the manufacturing is located essentially in, say, Tamil Nadu or in Maharashtra? So it's not some divine boon that it has happened. They are located, there is a certain culture that the state has developed, and there is a geographical advantage. You're closer to ports, you're closer to transportation, and then you have skilled capital. That aspiration, I think each and every state has now. The happy part is that, as I said, and I repeat, every state today in the federal environment is extremely competitive. Look at the Foxconn project. Bangalore, that's Karnataka, and Maharashtra, and few other states, they're all competing for that one project, and they're writing to both and Telangana. Yes. So and the Foxconn is writing letters to both the chief ministers, Telangana and Karnataka, saying that I'm coming. You keep wooing me, I'll come there, and I'll finally decide who to go for. So that's the positive side. The negative side is, I think, because of the political environment being little intense, 2024, and Tamil Nadu being run by a non-BJP government, and centre also intensifying its pressure on, say, Telangana and Tamil Nadu in other matters. So in that sense, this is showing, the pressure is showing somewhere else. So where does the rupee go and where does it come from? This, I think, is incidental, though it's very important to discuss it. But there is no outright solution that suddenly UP will stop getting the money, or Uttarakhand will stop getting the money, and Tamil Nadu will get all the money. It doesn't work that way, and I think the Tamil Nadu finance minister is a bright chap. He also knows it. But he knows it, yet he'll keep pushing the envelope.
Okay. How do you see the politics of it playing out, Brijesh?
No, he very well put out, that politics is going to further intensify. They all know that what they are rooting for. Elections are around the corner. Every party would want to win as many Lok Sabha seats as possible to ensure that they have a very commanding say when it comes to 2024 general election. And the reason why PTR is also going, all guns blazing is also, to push for the Tamilian pride and how, we perform better than the center in all the index. So, when it comes to to election, we are a better bet than against the kind of politics which is being played by the BJP, or the kind of push which is being made by the BJP. So that factor is also there at play. BJP has a new party president there who is Annamalai, who is going very ballistic, taking Stalin government to task. So I think there's a lot of politics, slightly less economic, but more of politics is there, and I think it will continue till 2024 general elections are held. But once the dust settles down and it becomes clear as to which party has how many Lok Sabha seats, I think then based on that margin, you will start understanding how it will play out post 2024.
Okay, I understand it's more political, less economics, but I'm still going to ask an economic question here, Rakesh. We know population is one of the deciding factors as to what state gets how much. What, according to you, if there is a change, if we can think of a change in the near term, what exactly should be the factors that should come into play, when decisions are made as to how much revenue goes to what states?
I repeat, Shweta, see, fundamentally, all of us have to collectively work towards increasing the size of the cake. If we don't do that, I'm very happy with one state competing with the other state, going for global investment road shows. All that should lead to increasing the size of the cake. If that happens, I think there's going to be some happiness at the end of it. Otherwise, if the size of the cake is reducing, how can you bring equity? Wealth creation is very important. For that, people who are making money have to grow. I think one redeeming factor here is the learning from GST. GST also started on a very contentious note, which state gets how much, because it's a taxation revenue. Finally, we found some solace there. There are still some challenges in terms of the GST structure, but by and large, for the last, I think, so many years now, ever since it's been built as one major economic growth story, born out of sheer consensus across political parties, I think that should drive our agenda when it comes to these contentious issues of which state gets how much money. But as an Indian, everybody is equal. Let's remember that. We'll make our politics, we'll win elections, but if we start dividing the country or the cake in terms of you are a poorer guy and I'm a richer guy, we are going nowhere.
Okay, let's not divide the cake. That's the message coming in from our business editor here, Brijesh. Thanks very much, Rakesh. Thanks very much for joining us on this big story. We're going to shift focus for now. In a bid to avert another bank from collapsing, the 11 largest banks in the US have injected $30 billion in deposits into the First Republic Bank. The First Republic was seen as a potential domino to topple after the collapse of Silicon Valley Bank a week ago, as it caters to a similar clientele as the failed bank. JP Morgan, Chase, Citigroup, Bank of America and Wells Fargo are each making a $5 billion unsecured deposit into First Republic. Morgan Stanley and Goldman Sachs are booting $2.5 billion apiece, while 5 other banks are contributing as much as $1 billion each. Banking stocks globally have plummeted since Silicon Valley Bank collapsed last week due to bond-related losses that piled up when interest rates surged last year, raising questions about what else might be lurking in the dark for the banking sector. Over the next few days, the turmoil in the market struck behemoths like Credit Suisse, forcing it to borrow up to $54 billion from Switzerland's central bank to shore up liquidity. Unconvinced, the US shareholders of Credit Suisse have now sued the Swiss bank, claiming that the bank defrauded them by concealing problems with its finances. What's more, DBRS Morningstar has cut Credit Suisse's issuers rating to BBB as it continues to report missteps and compliance failures, resulting in a visible weakening of the franchise. The move follows Moody's early saying that it will monitor Credit Suisse's situation and act, and I quote, appropriately regarding its rating. Now the big question is, will the crisis reach Indian shores? Joining me in the newsroom is my colleague Karthik. Rakesh continues to be with us. I want to first come to you, Karthik. It seems that the banking sector in the West is coming together to make sure that the another one doesn't happen. How bad is this situation right now?
Well, Shweta, a lot of people have said this before, and I think I can only reiterate that this is pretty much a domino effect. One chip falls and the entire chain goes down with it. So what are we really looking at? I think in the case of, of the Silicon Valley Bank that we saw that there was this typical case of a bank run. What happens in a bank run? One person goes, wants to withdraw money, gets his money back. 5 more people go, they want to withdraw their money, they get their money. As soon as that number becomes, a large number, the bank runs out of its liquidity to offer the depositors who had parked their investments thinking that it is a safe place to invest their money. Now, what banks typically do is that banks don't keep all the money with themselves. Part of it is meant to be held, which is the cash reserve ratio, and different countries, different banks sort of operate differently on that. But there's a fixed cash reserve ratio by central banks, which ensures that a certain volume of the deposits that are resident with a bank are parked either in the bank itself or in the central bank. So in case of any required withdrawals, there is enough liquidity available with the bank to service that regularly. Now, as soon as that figure becomes huge, the other assets that the bank has locked away somewhere, which in the case of Silicon Valley Bank we saw a lot of it was stashed away in the debt instruments, the federal debt. It's impossible to withdraw it at short notice because it's a long-term heaven in which you've parked your investment, and we saw it was also giving a much smaller yield than what the market was offering at that point. So it becomes a scary situation where people lose confidence and lose faith in the financial institutions of that country. So we saw it started with Silicon Valley Bank, and then we had Signature Bank, and now we are also seeing a similar case with First Republic. In between, we saw the Credit Suisse case. Of course, it wasn't as much of a bank run case there as we've seen in the US. But coming back to Indian banks, I feel the kind of structural reforms that we've done in our banking and the kind of robust measures we've taken, the regulator has taken and the central bank has taken to keep to safeguard the banks from NPAs, to have the proper risk management practices in place, have given that confidence to Indian depositors, Indian investors as a whole, that the Indian banking story has largely been insulated from the global shocks that we are seeing in the developed world. I mean, there was a point in time when India's banking system was criticized. People looked down upon India and the third world countries, and there were models in the West that we were asked to ape and implement and follow. If you ask me, we've done a much better job than our developed Western counterparts when it comes to it.
Okay, yeah. It looks like there's confidence in the domestic market, and your story seems relatively intact. And we were discussing this just a while ago. Rakesh, I want to bring you in. What's driving this confidence?
As Karthik mentioned, we have quite a few, the institutional framework, the citizen framework, the democratic framework. We have our own challenges, not that everything is rosy about Indian banks. But over a period of time, the reform narrative has been really embellished. And the good thing about reforms in the banking sector when it comes to the citizen perspective is that it cuts across all political parties. You would see that there's a broad consensus when it comes to procuring and protecting investor interest in this country. Even if it's a small account holder, he or she knows that there is an overarching architecture which will protect him or her. For instance, I just make it, if ATMs go dry in India, it's a front page story. So that's the level of governance when it comes to, and everybody from RBI governor to the finance ministry, joint secretary banking, they all get into action because the citizen outcry is very important, and the digital framework in terms of registering a protest is phenomenal. Second, in terms of the core protocols that Indian banking structure has employed is also very strong. The Basel III norms and the entire portfolio. If you do the SVB comparison with any Indian bank, it was essentially a startup tech-led deposit which went every. But in India, all the banks, in the public sector space, in the private sector space, they're hugely diversified geographically. They are hugely diversified in terms of the sectors and businesses that are parked funds there. So in that sense, we are, much better placed. And in fact, one may be, tempted to make a comparison. This entire sermonizing by the more developed and Western world when it comes to, telling what we must do. There is a message here. We shouldn't celebrate, but we should point it out that Credit Suisse, for instance, all these big banks, they do advisories on Indian narratives. For example, or on Indian entities. SBI had a record profit of $1.8 billion in the last quarter when the results were announced. Credit Suisse has a loss of $1.5 billion. Yet, I am told Credit Suisse did a negative run on SBI. So that's the level of, I would say, knowledge mismanagement when it comes to, looking at these banks. And for instance, when, probably Credit Suisse was looking at Adani, a fair job to do, but is someone else looking at what Credit Suisse is doing? So there are some lessons to be learned, and there is need for sustained watchdog approach from our diverse stakeholders, from the central bank, from the citizenry, from the finance ministry, And everyone. I mean, in India, the best thing is that anything goes wrong, it suddenly becomes a political issue. When it becomes a political issue, like we were just now discussing, the revenue share between states and the center, every antenna goes up. That's the good news.
And if I can just add to that, a very interesting point that you've made on, on the watchdog being the West and sort of, looking on India and rating Indian banks. But I think more important to note here also, or equally important, if not more important, is the fact that even the Indian investors, the retail investors as well as the institutional investors, are not taking knee-jerk reactions with their investments. Absolutely. I mean, just before we started rolling this show, we saw Bank Nifty was up about 0.3%. I mean, where else in the world do you see that, there's a major financial meltdown anticipated, again, that Lehman moment that people were referring to, where one bank goes bust and there are 3 more, 4 more, and the chips start falling. But we've seen that impact hasn't really accrued to the Indian investor, not just the Indian depositor. The Indian depositor, of course, is safeguarded by the structural reforms, but that level of confidence and awareness has percolated down all the way to the retail investor and also the institutional investors, Indian as well as those from abroad. So that story has come out, I think, fairly loud and clear, and I hope we don't jinx it. We are praising it. I hope we don't jinx it. But I think that story has come out loud and clear that that we have been able to insulate our banking sector, both for the depositors and the investors alike.
Okay. We haven't runs on NBFCs, but there again, we have taken corrective actions. I think one little area that still needs attention is the chit funds, which is the informal banking.
Right.
That again is, it's not exactly in the eye of the regulation, and a lot of people, who are not that educated, tend to go in it in view of the large returns that are promised. That may not happen, but that's one area where I think, given the global scenario, which is extremely shocking, I think when you were reading, it was like a riot act on the banking run globally. So I was getting scared. Where does it stop? And you said India. So I think this is where it's getting stopped. Stops at India.
Okay.
Hopefully, so far so good. But the informal sector needs that little extra layer of attention.
Okay. Pratik Kothari is joining us at this moment. He's an investment analyst. Pratik, let me begin by asking what's happening in the US at the moment. We will come to India's story in just a bit, but the domino impact we know hasn't reached India just as yet. What exactly is happening with banks in US and the bank run for that matter?
No, first of all, thank you for having me. I think the biggest issue which has happened this time is unlike what has happened in the past. So if you go back to 2008, it was the lending which all of these US banks did, the assets which they had built up, which kind of went belly up, and that was the issue which happened. But this time what has happened is all of these banks saw record savings from US consumers, either because they were not saving, they were not spending during COVID, or the government had huge stimulus package where they got a lot of money in the banks. And all of these banks in a short period of time, they got a lot of deposits. I mean, the Silicon Valley Bank went from, I believe, $60 billion of deposits to $150 billion in a matter of 2 years. And they did not have the opportunity to invest this bank to invest or give out loans in any matter. So what they did is they went out and made some investments at interest rates which were prevailing there. And I mean, it's a well-known fact that we have seen the largest increase, or the fastest pace of increase in interest rates in the last year or so in the 80-year history. As the investment or bond goes, as the interest rate goes up, your price goes down. And there was a huge mark-to-market hit which all of these banks saw. And
so Pratik, if I can just come in here, this is Karthik Malhotra from the studio. I want to understand what went down with First Republic. I mean, the SVB story has been covered fairly well, and everybody has seen what has happened with SVB and even Credit Suisse. But this morning we woke up to news about First Republic as well in the US. Is it the same bank run issue which is continuing across all banks in the US?
It very well can be, because what happens is this is an so like in banking, it is said perception is reality. And once there's a loss of confidence in any particular sector or in a particular bank, and especially such small and medium banks which are not as regulated as much as the larger ones, your Wells Fargo, your Citi, etc. Your retail public or the people who would have kept the deposits there, they lose confidence. And just as any normal human would do, you would want to safeguard that. You would want to take your money out from there and then maybe park it in a larger, safer bank. That might be a perception, but I mean that you try and save yourself at that point of time.
I agree with you. I want to understand. You've seen Bank Nifty is up about 0.3% in today's trade. Are we completely insulated, or do you think the tremors, the aftershock of the tremors are yet to reach India?
True. No, this is, and you rightly said. I mean, if you, so this whole US bank issue started from last Friday, and if you look at Bank Nifty, it's down about 2.5%. I mean, Bank Nifty can be down 10% in the blink of an eye without any reason, and then maybe we go out and find reason. So this is fairly a very normal behavior. Obviously, this affects the sentiment a lot, especially by foreign investors, because usually when some so from a fundamental issue, that doesn't seem to be any fundamental issue, but from a market perspective, obviously sentiments drive your short-term and medium-term outlook, and you would have some selling. But having said that, there's hardly been any selling which has happened. I mean, Bank Nifty is down 2.5% for the last 1 week, which is negligible.
Okay. And we also saw that about $1 billion worth of withdrawals that happened at the SVB from Indian entities. About 200 million of those, which is a fairly decent 20% of that, has come to Gift City, Gujarat. What do you read into that?
Honestly, nothing much to read about it. I think it's normal behavior. I have not
No, the
not
point
too much
being
information
that
about this, but
the investors or the depositors who had chosen a US-based bank to park their deposits in have withdrawn and put that back into India. So does that speak something about the Indian banking system or the risk management practices in place here? Or is it a general loss of faith in developed market banks and a slightly better level of faith in Indian banking?
I mean, partially I do agree to what you're saying. I mean, so say, let's say what happened during the times of the Yes Bank issue 2-3 years back. So naturally, you tend to withdraw your money from Yes Bank or similar level banks and go and park it into HDFC. So as human, we kind of feel much safer when our money is closer to our home than if it is lying outside in the US. And hence this seems a very, very natural reaction to what has been done.
Okay. We'll stay on Pratik. We also have Madan Sabnavis joining us. He's the Chief Economist at Bank of Baroda. Madan, thank you for joining us at this point in time. Let me quickly begin by asking you, what's the sentiment among clients in relation to Indian banking stocks? Are we insulated? Yes, we are. How much is the question we're asking here?
No, I think if you're looking at the banking sector in India, I think we are fairly well insulated right now, because while there has definitely been a kind of a percolation of the crisis which began with SVB and then going to Signature Bank and now Credit Suisse. But I think we should realize that there are different models which are being followed by different banks. And if you look at what's done in India, I think what we do is pure commercial banking. And I think that's one of the reasons why the risk from other businesses don't tend to flow over to the commercial banking section, which is what we have seen in terms of Credit Suisse, which, as we all know, is just around 25 to 30% is really commercial banking. The balance goes most into wealth customers or into investment banking, and that's where the problem really started. So I think what is really important here is the amount of regulation which is there and what kind of structures we're following and how much of risk insulation takes place based on the structures which we are following in the banking system.
So how's the story on risk management different between India and, let's say, the banking sector in the West? So we saw in the case of Silicon Valley Bank, this whole bank run issue surfaced because of the fact that there were long-term instruments in which the bank had parked its money. And then, of course, the domino effect, one thing leading to another, and the chips started falling. But in the case of India, what are the risk management principles in place that, that help us hedge against an eventuality like this?
No, actually, if you see that it was not really a very risky thing which the SVB did, because they were doing conventional banking activity. But it so happened that the structure of deposits was such that most of the deposits came from startups. And instead of going in for conventional lending, which was again being done to startups, most of it was being invested in federal securities, federal treasuries. So if you look at the Indian banking system, what do? We get deposits which are very diversified. It's very broad-based. We have a large amount of retail segment which is there. Then if you look at what happens on the asset side, we have loans being given, which could be around 70-75%. If I look at my credit deposit ratio, and then we have certain kind of investments which are made in government securities. So I think that's where the difference is. Now, what happened in SVB is we are talking of US treasuries, we're talking of Federal Reserve increasing rates to say 4.5, 4.75. And then we saw the 10-year bond, which was less than 1% going up to towards 4% during this particular regime. Whereas if you look at India, we don't see this kind of volatility in the bond yields. So typically what's happened is that even though the RBI has increased the repo rate by 250
I was
basis
just going to
points,
ask you
we
about that.
haven't seen
Yeah.
250 basis points increase in the 10-year bond yield. It's gone up around 40, 50 basis points. So intuitively, the kind of losses which could be made by Indian banks on account of security valuation is much lower than what we have seen in the US. So I think
Oh,
the concentration, the absence of diversification on both the assets and liability side, as far as SVB is concerned, that created a problem. Even though they were doing a traditional or a conventional banking business, whereas in case of India, I think things are better structured. So prima facie, it does appear that we are insulated.
right. So if you look at your own treasury, Madan, how would it have been different, let's say, a year ago when we were in an average, a moderate or a low moderate interest rate regime, and now that we are in a higher interest rate regime, would your bank also, and banking in general in India, would they have cut off their exposure to bonds? And even though the inverse relationship has not been that stark in India, but would banks automatically have reduced their exposure to bonds and taken on to higher interest rate assets?
No, no, not necessarily, not necessarily. But it's also true that when the interest rates rise, your treasury income definitely comes down. But then you make more money on your conventional lending. So overall, if you look at the proportion of how banks are run in India, most of it is more the money is made more on lending rather than on investment. So I think that's where the difference is. So
I think we seem to have lost Madan here.
what we saw it during time of a lower interest rate regime that the treasury gains were very high. The treasury gains were very high, whereas the net interest margins were lower on lending. Whereas today we have the situation which is reversed. So actually, this kind of a scenario actually works well for Indian banks compared to what the scenario was when the interest rate were kept low by the RBI.
Right. And how do you see the Fed playing this out now? Of course, we have the FOMC expected next week, I think on the 21st of March, if I'm not mistaken. And about a week ago, 8 days, 9 days ago, there were rumors that the Fed is going to pause the hawkish stand it has taken on rate hikes. Uh, Before that, we were talking about a 50 basis point increase. Now people are taking a middle ground and saying that maybe a 25 basis point increase is likely to happen. In light of whatever has transpired in the US, in Europe, in the last 7-8 days, what do you think one should expect from the FOMC?
No, I think it'll be interesting to see what the FOMC bats for this time, because we were actually looking at a 50 basis points increase in interest rates. But given the fact that what all these developments which have taken place, it could be more modest, as what you were saying. We could go in for something like 25 basis points. But I think as far as the market is concerned, I think they would be very, very keen to observe as to what the Federal Reserve does. The reason is very simple, that all this while we are talking in terms of quantitative tightening, the Federal Reserve has taken a position that we're not out to bail out banks which fail. We're not here to save the investors, but of course we're there to protect the deposit holders. So I think the decision which they take and the commentary, rather the language which is used, I think that's going to have a bearing on the markets. I think that's what the market is going to watch out for. So I think 25 basis points looks almost given, not 50 this time, but definitely the language, the tone, I think that's something which it would be looking out for.
Okay, and what about the RBI? Are we going to follow suit next month, or because see, inflation has cooled off partly. I mean, from 6.52 it has come down to 6.44, and of course we are looking at inflation data of the previous month. So you know, with the measures RBI has taken, there are chances that inflation would cool off even further. So does it necessitate RBI taking the hawkish stand and following in the following the cues of if not in the footsteps, following the cues of the Federal Reserve?
No, to my mind, I think another 25 basis points hike is warranted. The reason is very simple. We've had 6.5, we've had 6.4, we're well above 6% range. Second, we also know very well that the heat wave which we have had in the last month, which is probably persisting also for the next month, is likely to affect the wheat crop, which could again have potential to increase rates. The third point is that we're also looking in terms of an El Nino development this year. And we have seen in the past that every time we have an El Nino, there's a potential for agricultural output to be affected, prices to go up again. So I think in keeping these conditions in mind, there is a justification for increasing rates by 25 basis points. Because the thing is, if we take a pause right now and we continue to have inflation in the region around 6.5%, it would be a bit difficult, a bit awkward to start increasing it, maybe the policy after that. So I think they probably have 25 basis points hike now, and then maybe a pause. And if I look at the OIS rates, which is a very good indication of what the market is looking at, they're also looking at something like 6.75.
All right.
Madan, just a little, we so far so good. The Indian environment is safe and stable. But as someone who's been looking at this space from a purely economics perspective, would you like to advocate some more additional measures so that the Indian investor, the Indian retail, could just peacefully sleep and be just not worried about what's happening next door?
No, I think what is important is to continuously see what the RBI has got to say. And I think what the RBI has done has been a fantastic job so far. And I think if we get a regular reassurance which comes from the RBI, and I'm quite sure when we have the policy coming out next month, there will be certain references made to the global situation and also some kind of an assurance or rather reassurance given to say that the RBI looks at the Indian banking system as being stable and firm. I think that is something which will help the markets to relax. But as we saw that even in 2007-8, when we had a Lehman crisis, India was relatively less impacted because of the fact that we follow a pure commercial banking model, and we had not gone in for any adventurism at that particular point of time. And where people felt that the Indian system was behind times because none of us knew what an MBS was. But I think all that finally did help to keep the system safe. So I think rather conservatism, which I've seen on the part of RBI, has actually meant that it's been very, very prudent in terms of opening up the sector. And while lots of people may feel that it's been very stringent, but I think in the financial sector where you're dealing with depositor holders' money, it's always better to be conservative rather than do anything which is more boisterous.
All right, Madan, thanks very much for joining us with all those details. Appreciate your time there. Shifting focus for now here on the bulletin, France is witnessing one of the most violent protests of the century. Thousands of citizens are on streets clashing with the police. All of this over pension. On Thursday, French President Emmanuel Macron brought in a controversial pension reform plan. He extended the retirement age from 62 to 64 years without a vote of lawmakers. Now, Macron's party argues reform of the pension system is necessary to sustain it long into the future. It has a projected annual deficit of 10 billion euros, which is approximately $10.73 billion each year between 22 and 23. Now, India is facing a similar predicament. The issue of old pension scheme versus the new pension scheme continues to dominate news. The OPS, under which the entire pension amount was given by the government, was discontinued by the government. The central government in 2004 for OPS increases government's liability. In short, OPS puts the burden of employees' pension on the states. Whereas returns in the new pension system involves contribution from both the employers and the employee and are market linked. But recently, Congress-led Himachal Pradesh government restored OPS, which was one of its major poll promise in the run-up to assembly elections, saying that the decision was based on purely social security and humanity, variations. So that, of course, was the reason given by the Himachal Pradesh government there. With me is my colleague Rakesh. Also in the studio continues to be Karthik. I want to first begin with you, Rakesh. Pension has become a socio-political issue in France and now in India.
Unfortunately, because we are adding to our problems. We at one level want to be taking decisions which make economic sense. If it's not possible, we want to take decisions which make both political and economic sense. That again is an idealistic situation. Here we are in a situation where we are forced to try and make virtue of a decision which is fundamentally flawed economics wise. Okay. And it's going to bleed us all as a nation. What's happening is that we got into this massive peer pressure between one state and the other state. And now we know that even in Maharashtra, which is the BJP ruled state, there is tremendous pressure. People have gone on strike, and the 4 ministers from Maharashtra government went and met the agitating employees and tried to, so to say, tell them that this is how it should be. But how it should be, that particular line is missing in terms of the overall narrative. I think both the center and the state governments, respective state governments, have failed to put on the table exactly the demerits of this particular challenge. While as if you look at 2 big economic proponents in the UP era, that's Montek Singh Ahluwalia and NK Singh. NK Singh, who heads the Finance Commission, Montek Singh Ahluwalia, who headed the Planning Commission. Both of them have gone on record repeatedly to say that we should not go for the old pension scheme. Yet, Congress leadership at the top, at the apex level, has said that we will persist with this, and now the startup in Indian political environment, which is Aam Aadmi Party, has already made an announcement that it will do so in Punjab. And as I mentioned, Maharashtra and quite a few other BJP states are privately ill at ease, saying that we don't want to go to OPS. So I think there is a need for a national communications perspective from the center and each state, saying that, well, it's important that you get pension, but this is the format where we can sustain the pension, rather than getting into a situation where there is nothing and the state gets ruined fiscally, which we are perilously close to in some states.
Okay. Karthik, explain to us the economics behind the old pension scheme and the new pension scheme, and why exactly are people more and more aligned towards the old pension scheme, asking for it, demanding for it, also in Maharashtra now?
Okay, so Shweta, if you'll allow me about a minute to come to the economic fundamental difference between OPS and NPS. I think what is happening in France right now is fairly interesting. It's a very different situation in France versus what we see in India. India has a young population, and if you look at Europe and Japan, of course, being the oldest country right now, but even if you look at most economies in the Europe, they have an aging population. What is also happening in the world right now is that the longevity has gone up. People don't die early. And the physical fitness, thanks to medicine, thanks to diet, thanks to an overall lifestyle, as much in India as in the West, of course, is the fact that you can work for longer. So I'm sure my older friend Rakesh would agree with me that maybe that the age of 60 for retirement, 58, 60, depending on what rank you retire at, etc. Maybe there is actual need to relook at that as well to reduce the pension burden, given of course attributes like physical fitness, mental agility, and all of those. So it reduces the pension bill, and you continue earning your living through working for that living. Of course, having worked 40 years, 35 years, again depending on what stage you retire at, you've given that much. But if you're allowed to if your physical fitness and mental fitness allows you to work, by all means, maybe there should be a relook at that. But anyway, coming to your fundamental question now, OPS.
A longer period,
So the technical difference between OPS and NPS, very simply put, OPS gives you 50% of your last drawn salary as pension for as long as you live. It has functioned very well for defense services, for retired government officials, etc. And when you join a force or when you join the government, pension is of course one of the key drivers for sustained employment. So the old pension scheme gives you 50% of your last drawn salary irrespective. Now, what does this do? I spoke about longevity, and I spoke about the fact that people are living longer, living healthier, etc. The pension burden obviously on the state government goes up, because you're giving that pension away with no collateral, with no exchange of service in lieu for those many more years. So how do you sustain it? The NPS is not something which India has devised out of the blue. I mean, anybody may want to take the credit or discredit for it, but NPS has been in existence in the Western world forever. Now, what does NPS do? NPS allows you to put 10% of your salary every month into the pension scheme, and the government contributes another 14% into that pension scheme. This corpus gets accumulated and gets invested in market-linked assets. Now, obviously, anything that goes, there are disclaimers. We ran a disclaimer at the start of this show, but any asset manager you go to, any investment advisor you go to, any kind of investment comes with a certain risk. Now, higher the risk, higher the reward, but higher the reward, higher the risk as well. So the converse is also true, which means that unlike the old pension scheme, where no matter what, it is the government's responsibility and it is completely the onus of giving that 50% of your last drawn salaries on the government, and come what may, you will get it. In the case of NPS, there are risks associated. Your money parked, let's say in 2017, 18, all the way till 2019, if your money, considering an NPS kind of a situation in India, if your money was parked in the market, we saw a bull run. Now imagine somebody who could have retired potentially in March 2020. We saw COVID, black swan event, call it whatever, markets tanked. For somebody who would have retired on, let's say, the 24th, 25th of March, all your life's savings are in an instrument which has crashed. Now what do? There's nothing you can do. You can do a part withdrawal, part of it can stay, and you can hope that it goes up, but that element of risk is always there. That is the crux of the reason why government employees don't want to opt for NPS. They joined the government services and they came into the forces knowing very well that they are going to get a pension. Come what may, you have served the government. It is the government's responsibility to look after you in your golden days, in your golden age. Now that your investment or your accrual is linked to a market-based product, that market-based product can go kaput anytime. Ideally, the fundamentals of personal finance should play in. There should be flexibility that closer to your retirement, if you have got the kind of returns that you had expected, you remove money from equity markets, you put them into a debt instrument, it continues to grow at a lower risk, etc. But the point is, financial literacy, even among the most elite in the country, is limited. So there is bound to be resistance from an employee level who had signed up knowing very well that they will get a guaranteed return, an assured return, and now they are being told that no, your assured return is no longer assured and it depends completely on the vagaries of the market. So economically, fundamentally, there is a huge difference between OPS and NPS. Can India afford OPS? Obviously not. So I agree 100% with Rakesh Kar. There is no way that we are going to sustain a large retired workforce for a very long time, giving them taxpayers' money and their own, of course, whatever they have sort of contributed to the nation, no denying that, of course. But taxpayers' money going to service pension bills is going to be fairly unviable, if you ask me. So what Andhra Pradesh government has suggested, earlier this month is something called a GPS, which is a guaranteed pension scheme. This is somewhere in between an OPS and an NPS. So an OPS will give you an assured return, and NPS will give you a market-linked return. A guaranteed return scheme could be something in between, where there is some assured return and there is some market-linked return. So, if something like that can be worked out, but I think we are too deep down into this debate of OPS, NPS that there would be any changes really in the draft.
Okay. Another criticism. Yes.
See, you have to put this entire issue in context. First of all, there are no free lunches. That's the fundamental rule of economics.
But if a free lunch has been promised at some point in the past, you can withdraw that free lunch also.
One, that there is no free lunch, and if it's there, it can't be sustained for long. It will bleed someone.
Okay.
That's what's happening. Third, government jobs today, what is the percentage that exists of government jobs? There are so many people in the organized sector who are outside of the government jobs. Don't they deserve a life, a pension? And lastly, we need to reimagine this entire landscape. If there is need for a guaranteed pension scheme, like Karthik mentioned, you have to factor in the private sector employees also. They also need certain social security.
And that's the beauty of NPS, that even the private sector can opt for the NPS.
Absolutely. I mean, so government jobs, government pension, committed government pension, then family pension, which I think we need to showcase, which is a golden social sector benefit, but at whose cost? The taxpayers' money? So somewhere down the line, the entire pension perspective has to be reimagined from its narrative point, from its policy point. We need to put heads together. And if I must say and play the devil's advocate, we need a divine intervention. And divine intervention today is that, I pray that our Supreme Court, comes into the play and says, this is an issue that, hurts the Indian economy. So let's try and find out an amicable settlement. There are some cases filed in the highest court where it's hearing even the other EPF settlement in terms of how much should the employee pay, what should be the pension formula. So together we need to look at this and have a very frank discussion, arguing that let's not make it political, but let's try and see what is the middle path.
Okay. Just to cater to your point, Rakesh, you said while it costs government a lot, it's only benefiting a few people, because under the scheme, government employees who have worked for more than 20 years are eligible. So all in all, it doesn't really help.
No, it helps those who are in that limited space. That's why they don't want to let it go.
But only those limited number.
Absolutely. So that messaging has to happen that, look, it's a limited number. There is a large piece of, and the young employed workforce which will get into the jobs, they have no idea about this assured government pension. You tell them this and they'll say, oh, I'll start looking for a government job, which doesn't exist.
Yeah. So Rakesh, if I can just ask you another question, in light of what we're discussing on NPS and pure finance, pure economics again, there is an EPFO already. it follows pretty much a similar model like the NPS that we are discussing. There is an employee contribution, there is an employer contribution. It is parked centrally with a government institution, which is actually investing that entire corpus back in certain market-linked and certain debt-linked instruments.
Not this
and
entire
offering
corpus.
you, not the entire corpus.
So again, there's a huge debate on that.
Yeah.
We've been very traditional in releasing even a small percentage of that into the stock markets.
Absolutely.
Had we been little more less conservative, little more modern, we would have fetched far greater returns for the private sector employee, and the overall transformation of this pension understanding in the country would have helped.
Of course, but I think why the EPFO cannot do that is again for the same fundamental reasons as the OPS, that there is an assured return that you have to give to anybody who has invested in the EPFO. So there is only this much risk that the EPFO can also take with the corpus that it has, and hence the returns are obviously not as high as one has seen in the bull run in the markets. But the fundamental question being that how would NPS and EPF really be very distinct, buckets in themselves? Wouldn't there be some sort of an overlap when it comes to a person planning his or her retirement? Because there's a contribution you are making, there's a contribution that the employer is making. One instrument is giving you a fixed return, which gets updated every now and then. And there's another one which is market linked, of course. So the modalities of both EPF and NPS seem a little similar to me.
And nobody is thinking of trying to find a solution, putting them together.
So that was my next question
absolutely.
to you. That should EPF
solution.
and NPS really be one combined bucket where there is a safety of investment which comes through the market practices and investment practices that EPFO is taking already into account, and I don't think it has defaulted, at least not in my living memory. And there could be a slightly riskier approach that NPS takes, and combine the two become a handsome retirement tool for professionals of the government sector and the private sector.
On the economic side, there's obviously a need for some out-of-box ideas. One is that increase the age of retirement from 60 to say 62 to begin with. It's there for doctors in the government sector. Some private sector guys take them as consultants, but that's a small drop in the ocean.
But wouldn't that actually lead to further unemployment for the youth?
And a France-like situation.
It's a question of, either or nahi hai. We live in grays. You need to retain some talent and put them. Not that I'm on
for an aging population, I think one should go with the France model. But for a country where you have which is fueled completely by the youth, wouldn't that lead to challenges of its own then?
No, there's an economic disincentive in retiring someone at 60 who is a bright mind, has tons of experience. All that experience comes to a full stop economically and has social consequences.
Sir, are you mentioning that professionally or personally?
I'm making a professional point while being personal about it.
Okay, then let me ask you a final question. How do you expect a person to buy into the argument of old pension scheme when they would very much happily would want an old pension scheme? How do you expect them to actually buy the idea of a new pension scheme?
It's very difficult. So if it were left to further discussion, I don't know how much time we have. But there's got to be a cutoff. You can't change this from OPS to NPS overnight. I think there's got to be a cutoff. People who are yet to join the forces or the services, government services, or who have been around for, let's say, 5 years, 8 years, 10 years. I don't have a number. I mean, there's no magical number. But it can't be done retrospectively. It can't be done for everybody across the board. I think the commitments that have been made to existing employees need to be honored, for some time to come. Of course, we will continue to bleed for, again, depending on the ideal cutoff date decided, we continue to bleed for another 5 years, 8 years, 10 years, or whatever. But I think it has to be choice driven for existing employees first, and all new workforce getting added to the government services. NPS should be made compulsory. But then again, do we have that sort of a runway to stagger it and space it out? I'm not sure.
Okay. And what sort of economic burden are we looking at? Because we know Punjab's been made a promise and Maharashtra is...
It would vary from state to state. Again, we discussed earlier in the show, that certain states are not making that much of money. Their GDP versus their expense is very high. So, GDP is on the lower side, expenses on the higher side. So those states, there is no one uniform figure. I think, the messaging has to be very strong. There have to be some out-of-box ideas. Remember that, we are in India yet a very socially cohesive family unit. Someone retires, he's not abundant like in the US. He doesn't need to go to an old age home, where there, of course, is social security. In terms of the finance, here it's, the fear that if I don't have pension till I die, and nobody will look after me is slightly misplaced. It's a guarantee that someone is looking at having served for 20 years and being paid for 40 years or 50 years. The average age today is 76, mortality rate. It's only going to increase. So the burden, the question that you asked about the economic impact, is only going to increase exponentially.
Okay. Well, obviously, we are all batting for the old new pension scheme for that matter, and we will continue to keep a track of that story. Thanks very much for joining us with all those details, Karthik, Rakesh. And with that, it's a wrap on this edition of Business Plus. Thanks for watching.